Hey, everybody. Welcome, 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 welcome. So good to see you. I'm Brad Haubert, and I'm home building consultant. So happy that you can join us today. Welcome to my little corner of the internet here as I go live for one of my first ones here under kind of a new kind of brandish that I'm starting up. It's called Welcome to Home Building. You can probably see it up in the corner as well. Really, all of this is about is I've been in this industry, for those who don't know me, since way, 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 way back in 1993, way back before cell phones and social media, and I'm feeling older as I say that. I age each second as I go through there. But anyway, what I'm kind of hoping to do with this over time is just be able to do things like this, give back to the industry. Maybe I've come to that point in my age or in my life where I said, hey, it's time to finally give back to things. And I found I had a knack for, my goofy humor to begin with, but just basically be able to take concepts and be able to teach them in ways that if I can understand them, anybody else can understand them. So over time, what's going to be happening, my hope is to have, perhaps this will become kind of a podcast for those new to the industry. A couple books I have kind of in the works and all kinds of other stuff too. So if you're interested in that, if you say, hey, I want to keep up on, just concepts, learn a little bit things as you go along, you can see down at bradhaubert.com. Really, it's just a site I've started up. All it does right now is collects your email, not so I can spam you, but just to let you know as the site kind of progresses along. You can get updates and kind of go from there. But enough about me anyway. I want to remind you that if you're wherever you're listening, if you have any questions at all during today's live stream, please put them in. I'll keep an eye here on the comments and try to answer them as they go live. But you guys are in luck today, because one of the things that I didn't understand when I first got into the industry, and I think a lot of folks new to the industry, whether you're in the real estate side or you're one of the home builders, is kind of really how financing happens. What happens and what are some of the terms on that. So that's what we're really planning to do. And I'm so honored. I was able to snag an industry pro who's just all over social media and the videos, all kinds of things too. And that's Rebecca Foote here. And Rebecca, thanks so much for coming in. If you want to give me a break from, the verbal diarrhea coming out of my mouth, and let you, just let people know who you are, what you do, what you've done in the industry too.
Absolutely. Thank you. Thanks for having me. As Brad said, my name is Rebecca Foote. I own the Rebecca Foote Mortgage Team, and my husband and I own Foote Capital Mortgage, which is located right in Carlisle. And we've been an independent mortgage banker now for over 16 years. We do everything in-house down to underwriting and funding your loan. So we have the benefits of shopping around for a mortgage for our clients, and then still the benefits of having control over the process, which is why we continued over the years to get more and more licenses.
Fantastic. And because this is going out, we're on the old internet, the
That's
wide
true.
world web now. We can go everywhere. So that's Carlisle, Pennsylvania. So if you're not in Pennsylvania, you don't know where the heck Carlisle is, it's in central PA, South Central PA to be precise on that. So, and again, if you haven't connected at all with Rebecca, you can take a look. You can find her on social media all over the place. I think I have your website here too. It's another good place to do this. But the reason why I wanted to bring Rebecca on here was just because she is out there. She's also out there educating people about mortgage stuff too. So you guys you're in luck on this too. So what I wanted to do, I wanted to start this off too, is just kind of go over some just general terms. Again, a lot of times all of us in the industry are guilty of throwing around words that you just take for granted, but those new to the industry aren't always really up to what that is. And as I get ready, I told you I'm kind of working on a few books and those types of things. One of the things I do is get questions from people who are new to the industry.
Mm-hmm.
And one was how do people pay for loans? So how are the buyers paying the builders? So I know this is focused really on the builders and those who represent builders for the buyers and all too. So let's just talk about a couple ways. Number one, builders get the money to finance loans, and builders a lot of times will get loans from banks to put up a house, put up a spec house. So if you've heard spec house, or even homes they build for their customers, they say, I'm going to just finance the construction. And then what happens is the buyer ultimately has to buy it, and they get what is known as an end loan. So Rebecca, if you don't mind talking a little bit first, let's talk end loans. And again, for those new to the industry, what this is builder is financing. They're shelling out the money as it goes until the end.
Correct. Yep. So an end loan is basically, I tell clients, think about it this way. You're getting a loan at the end of construction. Mm-hmm. So as you said, the builder is financing it, and it would be no different than a buyer buying a house from any other seller, an existing home. So they're going to get normal interest rates, whatever the going rate is at that time. There's no extra fees for it because it's truly just a normal 30-year, 15-year fixed rate, whatever loan type they want. So if your builder is willing to finance it for you, we tell clients go that route because it's less fees with that loan type than having to do a true construction loan.
That's good to know too. And I think, and just, being Central PA builder, we almost always use what we're going to talk about next in here. And the end loan really wasn't something maybe, just here in Central PA, you didn't necessarily see that a lot. But I know across North America and the builders I work with all over the place, you see that a lot where they actually do finance it. They own everything until the end. So end loans are
like track builders that tend to do that.
Perhaps that is right. So this next loan that we're going to talk about too. So that's the end loan, comes at the end. The builder's financing throughout would be a construction loan, or what some call construction to permanent loan at the end too. So why don't you talk a little bit about how that's different than what we just talked about with the end?
Okay, yeah, this is a whole different ball game. So. So a construction loan is you're getting a loan and you are paying for construction as it is happening. So I'm just going to use some round numbers to keep things very simple at the moment. Right. Let's say the lot is $100,000, construction is $400,000, which I know in today's market is not going to buy you that much anymore. But
fair enough.
But for easy sake of numbers, so at settlement, you're going to buy the lot, whether it's owned by the builder or it's owned by a separate entity, and So at settlement, you're going to have whatever your down payment is on it, and then you're going to take the first draw, if you will, to pay any lot cost.
Okay.
So we're going to start out with, you may not have any money on your loan at that time, or you may have a little bit. Think of your loan as like a line of credit. Is the best way I say to do it. So once the builder, digs the hole in the ground, puts the foundation in, usually it's at that point they want draw one, and draw one is where we are just reimbursing the builder for what they have done so far. So a lot of times builders will give us draw schedules that are in 20% increments. So in this scenario, we're going to release $100,000 to the builder. You do typically have to sign off on it. You're also having an updated appraisal inspection done to verify, yes, the work was done.
Right.
And we release the $100,000 to the builder. So now on your line of credit, you have $100,000 plus whatever you had from the initial settlement day, and you're paying interest only on these at this point. So throughout construction, as we release more and more money to the builder, your payment is going to increase based off of what is drawn on the loan at that point. Does that make sense?
They're just are they making any principal payments at that point? I mean, people understand what they're doing at that point, or is it just, what payments are you talking about that happen as it progresses?
So typically it's interest only. You can always put money on principal. Nobody's stopping you, but typically it is interest only during construction. And then at the end of construction, when the house is actually completed, we release that final draw to the builder. So they are paid in full. And your loan, we tend to do a one close loan, which means your loan will convert into a permanent mortgage. So you're going to pick up front. Do you want a 15-year loan, a 30-year loan? We'll work with the client on that, and it converts and rolls into that permanent mortgage. Now, sometimes you can do a two-close loan, which means you close once, you handle the construction loan, and then at the end of construction, you go through the mortgage process all over again. You pay a whole other set of closing costs, but that's how you get into your permanent loan because you're picking it at that point. Now, there's not a lot of benefit to that. I tell people if we can do a one close, let's do it, because that way you're not paying two sets of closing costs.
Yeah, I never understood that. I mean, all the years I was building homes, I'd always wonder why the heck anybody would do two close, because it just seemed like a double set of closing costs that you never wanted. But it's
there was a time after the 2008 housing crash that's all you could get, but since then it has come back to the one close.
That's interesting too. And it was also important to note one of the things you said there that maybe folks didn't necessarily pick up. A lot of people will come in and say, what happens if the lot is owned by one person and then the builder's coming in doing that? And you've already addressed that. So you took my question away on that.
But I can say this too. Like, let's say you already own the lot. Maybe you own it free and clear. you can use that equity in the lot as your quote unquote down payment and to pay your down payment and closing costs. So
man, that sounds like a completely different live stream event at that point too. We might have to chalk that one up for a future one too. That's fantastic on that too.
Everybody's situation is different.
I'm sorry?
Everybody's situation is different.
Yeah, that's true. That's true. Now, on the end loans that come, because obviously construction can take, depends on the builder, 3 months, especially in today's environment or what it has been the last 2 years, they've been stretching out over that too. So that's kind of a long time. And at one point, you could get, and we're going to jump over to interest rates here and we're going to talk about that, but you could get an interest rate lock where you're holding that for 6 months down the road.
Yeah.
Same with construction. You're settling at the beginning, so technically the loan's there. Are you still seeing locks that long at this point, or has that significantly shrunk down now?
So as we're going to get into rates in a little bit here, rates have drastically changed in 2022. We've had, they've doubled, more than doubled at this point. So yes, you can lock in your rate that far in advance. You're going to pay for it.
Oh, is that right? Okay.
Yeah, you're going to pay because you're asking a lender to guarantee a rate 6, 9, 12 months into the future. And with the way rates have gone this year, that's a big risk on their side. So you're going to pay to lock it for that long term.
Okay. Yeah. And in the past, when rates were more normal, as we talk about them now, it's subjective, of course, but at one point I know that you could lock the rates, and if it went down, you were okay. The lender would give you the lower rate, and I'm assuming it's probably the same, but hopefully it's not.
It's called a float down. So if rates drop during construction, you can float down at the end to a current rate.
Well, great. Well, let's talk about interest rates again. Most folks hear about this. They hear about them in the media. They're hearing they went up. Let's talk a little bit about the interest rates. We understand it is a financing fee. We get that. That's what we're paying. That's how the lender makes its money. But all the stuff you're hearing in the media, should sellers and buyers panic? That's probably a real question. Is media just blowing it up because it's the media and that's kind of their job to sell newspapers and newspapers? I can tell them to sell, their services, to sell to their advertisers, to bring to their website and their social media channels.
Yeah, there's no doubt media is not good for our industry. They tend to tell you all the bad stuff.
Sure.
For example, the mortgage applications are way down. Well, of course they're way down. We just came off the largest refinance boom in history. Everybody refinanced, and they're going to come down. We expected them to come down. But if you realize and you look at the actual numbers, we are still doing $4 trillion in applications this year, which is actually way above normal. So you can't just go off the headlines. You have to really dig deep into the actual numbers.
Yeah, and that's a good point. I saw a post on LinkedIn. I'm lurking around LinkedIn usually each morning and I saw someone do the same thing. They gave kind of a story, but they said, well, if you kind of get past the headlines, you can really dig in and you have to take it all in context. So I think that's great advice on there too. So at one point, interest rates, we are changing. Are you seeing the changes? How often is it changing? I know way back in the old days before we had the cells all, and we were still using fax machines. It was pretty novel remembering our first fax machines. You get the rate sheets faxed across once a day or once a week or something like that. Probably aren't faxing them out to anybody these days. And maybe, I don't know, is the rate sheet still a thing out there now?
So they do still release rate sheets. They get emailed now.
All right.
But I can't tell you anybody that uses rate sheets. The thing is, now there's over 30 different factors that go into pricing a loan. So years ago it was, you want a 30-year fix? Well, here's the rate. And it's not like that anymore. How much you're borrowing, your loan type, your credit score. There's so much that goes into even where the house is located. So a lot goes into it anymore. So what my 30-year fixed rate may not be the same for you. And so now we all use, everything's computerized these days. So we all have, think of it like a search engine. We put in exactly the borrower's criteria, and it pops back with different investors and what their rates are. So that's how we shop rates for clients. Once we have all the criteria, then we can see who has the best pricing that day.
How about that? Interesting stuff.
Yeah.
So for those who may not be real well versed in interest rates themselves, is there a rule of thumb to say, per $100,000, we'll just again use a round number,
Mhm.
what a jump in an interest rate will do, like either by a quarter point or half a point or 1 point or however. Um, I don't know if you get asked that often or not, but and I'm talking, just on top of whatever that, whatever their initial payment
Sure.
is, so principal payment.
Sure. So for every $100,000 you're borrowing at, let's say, 6%,
Mhm.
your principal and interest portion of your payment is $600.
Okay.
Now we are here October 2022, and right now we're hitting more of the 7% range. So
Mhm.
that's costing you $665 for every 100,000.
Okay. You say that's principal and interest, or I'm sorry.
Principal and interest, yep.
Okay.
And don't
All right.
forget to account for taxes and insurance with your payment, because that's
Sure.
going to increase it as well.
All right. Fair enough. Fair enough. Well, that's a good rule of thumb for anybody kind of that they're talking to their clients too. I want to be able to tell that too. So we talked a little bit about the interest rates, the rate sheets, as we talked about, and how you could get different rates or holding the rates. And one of the terms that lenders use a lot of times are points. You can get a certain percentage point or percentage rate for X amount of points, maybe a lower one for additional points.
Yeah.
So for those not real familiar with what that means, what exactly is a point?
Sure. So a point is a fee that you can choose to pay. Typically, you're paying it to buy down your interest rate. And as a general rule of thumb, for the first point, sometimes the first 2 points you buy, you're going to buy down your interest rate 0.25%.
Okay.
And 1 point equals 1% of your loan amount. So on a $200,000 loan, 1 point is going to cost you $2,000. And as a general rule of thumb, you're going to get 0.25% off the rate for paying that point.
Okay. That sounds good too. So that still rings true today? I mean, you still be able to go and say, hey, when I talk to and I'm just going to say the points, that buyers can still pay points to change your interest rate.
Oh, yeah. You can definitely do that. The way our current, depends how detailed you want me to go, our current market right now, as I said, our rates have more than doubled since January.
Okay.
So in January, you could do a 30-year fix around 3%. Now you're, like I said, you're at 7. So give or take, and that's actually with points right now. And the reason that you're being forced to pay the points is because lenders know that probably early next year, I think it's going to be more like second quarter, maybe even third, we'll see, that you're going to see rates come back down. And everybody's going to be refinancing into lower rates. Like they're telling us we should be below 5 next year.
Is that right? Okay.
We'll see what happens. I don't have that magic ball, but mortgage rates are based off of mortgage-backed securities, and that is just a bond that people are investing in. And you and I have probably invested in it in our retirement accounts, and you just may not realize it. But you're investing in these bonds, and when you invest, you want a solid rate of return. But as inflation's increasing, you're going to demand more and more on your return to keep up with inflation.
Sure.
And so inflation really drives rates, and people don't realize that as we've gone up in inflation the past year, that's why mortgage rates have come up. And as they bring inflation back down, you will see mortgage rates fall back down as well.
Okay. Well, you heard it here first, folks. If it's not below 5%, you know who to. No, I'm just kidding.
Not yet.
And you know who to call. It's
you can have whatever rate you want, but how much do you want to pay?
RebeccaFoote.com. That's how hands off. There you go. No, I appreciate that too. So we talked certainly about the points from the buyer side, and one of the reasons for this live stream is there's a tool we used back when rates were a little higher back a few years, where we did what was known as a builder buy down. And the reason why I kind of wanted to go through interest rates and points and how they can do that is because we used that in the past as a builder to help bring the interest rate down on behalf of our buyers. So obviously you build it into the price of your house and then say, hey, we'll pay. At the time we were able to say, we'll pay, X amount of points to bring that interest rate down. And I was kind of predicting this a little bit earlier in the year when I said, hey, I think we're going to start seeing this before, especially as the interest rates rise. And now just talking with builders, yes, we are seeing that. And wanted to see if, any builders that you've been working with, have you been seeing that, and exactly how does that work?
Yes. So I do just want to clarify one thing. When we were just talking about points, that's a permanent buy down. So
Okay, right.
you might take your rate from 6 to 5.75 by paying a point, not in today's market, but as general.
Yeah, sure.
And that's a permanent buy down. Okay.
Okay.
And what we're going to get into is a temporary buy down. So
okay.
I can, I'm going to share my screen. So those of you that are able to view.
And so while you're doing that, is the builder cannot do the permanent buy down? Because I thought that's what we had done in the past, but things change, I realized too.
So two things. I don't have access to share my screen. I just realized.
Okay.
While you're doing that,
All right.
yes. I mean, a builder can give you, it's all done through what's called seller's assistance. So a builder can give seller's assistance, and you can use that money as paying permanent points to buy down the interest rate permanently, or you can use it for a temporary buy down. So there's two options.
Okay.
And in the market right now, I would tell people do the temporary buy down because you're more than likely going to refinance it for a lower rate.
Okay.
So I want to make sure that we're using the money to the client's full benefit.
Yeah, and it's live TV, folks. It told me you were going to be able to share it, but for whatever reason,
that's all right. We can still explain it without. So basically, what happens if you do a temporary buy down, and let's say interest rates are at 6%, we're going to take that same seller's assistance from the builder, and we're going to put it into an escrow account at settlement. So instead of you using that money to help pay closing costs the day of settlement, it's going to go into an escrow account. And
wave at whoever that was. Your fans, right, they're everywhere.
Drag, so we put the money into an escrow account, and then you're going to lock in your interest rate at whatever the rates are today, right? So let's just say you locked it in at 6%. Then if you do a 2-1 buy down, the first year you're going to get 2% off your interest rate. The second year you get 1% off your interest rate, and the third year you go to the normal 6%.
Gotcha.
So year one, instead of paying 6%, you're paying 4%. Okay. So here's the thing: you locked in a rate at 6%, though. The lender still needs paid the 6% payment, not the 4% payment.
Okay.
So that's where that money in the escrow account is going to come from. It's going to subsidize the mortgage payment. So, you might make a $1,200 payment, and $300 is on top of it is coming from that escrow account. So the lender's getting their full $1,500.
I see. So they're not being paid necessarily up front. They are being paid each month out of the escrow.
Correct.
Okay. And maybe that's what was happening. It's been a while since we had to do that. Maybe that is exactly how it was being done, and I was just too young and dumb to know about it at that point.
Well, you can do it either way. It's important that people understand this is not an adjustable rate mortgage. You're still locking into, let's say, a 30-year fixed rate. It's letting people ease in to the higher interest rates, and it's helping them with inflation the way it is. It's helping them maintain those payments, and because like I said, we know we're going to refinance these people next year, and any money that's left in that escrow account is actually paid towards principal when you do a refinance or sell the property. So the client's it doesn't cost them anything to do this. They're not going to lose any of that seller's assistance. It's just, do we use it for a temporary buy down, or do we use it for a permanent buy down?
Okay.
Does that make sense?
Yeah. Now, are you seeing more buyers right now trying something like that, or sellers offering that, or are more buyers looking at an adjustable rate that is lower, figuring they're going to refinance, or a little both? Or do you have a percentage if you had to estimate?
I know on a national average, ARMs, adjustable rate mortgages, are up from where they were previously. We haven't seen a big increase here in central Pennsylvania of ARMs. We're telling sellers and builders the same. Don't just take $15,000 off the price, right? Offer a seller's assistance, and then you could do the buy down. Like the buyer can use the money however they see fit. If they need it for closing costs, then you do that. If they need it, they want to ease into that payment, they can do a buy down with it. So it actually costs the seller or the builder less to offer the seller's assistance than it does to just keep reducing the price.
Sure. And it messes with appraisal values too, I'm sure, as you go along with it. Fortunately for the builders right now, the lumber is getting down to that pre-pandemic level. So, the prices of a lot of them, they've taken their sales prices up to account for that. Now, if they're coming down, they have some wiggle room on there to do that. I was talking to a builder yesterday. They did that. Another thing they were doing, they actually said one of the offers they made up to their customers of, hey, if you go ahead and close under whatever interest rate this is, we'll actually pay if you go to refinance within a certain time, whether it's within a year or whatever it is, and the interest rates go down a certain percent. So I thought that was kind of an interesting kind of promotion too. Are you seeing any other thing, or, again, just from builders or, sellers on that end where they've done outside the box thinking, I'd say?
The only other thing is something that I think is always still used is, we'll give you X amount of dollars in upgrades.
Okay.
If you buy now. I saw a national statistic that the people walking away from new builds is increasing right now.
Oh, wow.
The people walking away from anything right now is increasing, but I saw new builds were higher than existing homes. And I don't know, it's obviously because of the rates. I don't know if it's new construction, correct me if I'm wrong, tends to cost a little bit more than an existing home, but you're getting what you you're getting what you want. You're getting new, right? So you don't have to worry about the furnace going out tomorrow. And
right. Yeah, and there's definitely trade-offs on that too. So.
Yeah.
Well, very interesting. Well, I wanted to keep this within the half hour because obviously it's, folks may have been joining us around lunch. I want to thank you so much for your time. Love seeing your videos and everything you put out there too. It's you're so informative, which was why whenever I decided to do kind of my very first live stream of this here, using my Welcome to Home Building type of deal, you're the person I wanted to reach out to.
Well, thank you. I appreciate that.
So thankful you took the time to do so. So folks, again, if you're out and about and you're looking for mortgage, especially if you're in Central PA, and I don't know if you go elsewhere, but it's probably easiest in the Central PA area, I'm guessing. There you go, RebeccaFoote.com. Again, if you have an interest in kind of just staying up to date on new things in the industry, BradHubbert.com. Look at that. We both have .coms after our name too. So thank you so much. I hope you have a wonderful rest of your week. Thank you, everybody out there too. And maybe we'll see you again here in the future. Thank you.
Thanks.